Hey Adam, it's Mark here with Money Show. How are you?
Excellent, Mark. How are you?
Yeah, I'm doing well. Thank you for joining us.
Thank you for having me.
Our broadcast is currently pushed live to the virtual platform.
Okay.
Um, will you be having a screen share today?
If possible, yes, but I don't need one. It's 100% up to you.
Oh, okay. Yeah, I mean, if you
I
don't
have
have
it.
any.
I have a deck. No, I have a deck prepared, but if it's hard to do a screen share, then I don't have to do it. I can
Oh,
run.
oh no, it's super easy.
Okay.
We can go ahead and get that loaded up. I'm just going to stop share on my screen,
Okay.
and you should have the button that says share screen.
Yes, sir. Let's see here. And then how long do you want me to go? Mark?
Yes, we have you until 1:30 Eastern time, so you have a 30-minute slot.
Okay, perfect. Do you want me
And
to
we'll
size it up so it's the size of the window?
Yeah,
The
that'd be
PowerPoint?
great. Go full screen. Yeah.
Okay. And then do you want the time slot and the date showing, or you want me just to size it up to the PowerPoint like this?
Um, that's good right there.
Okay, perfect.
Yeah, looks great. So we can just keep that up there
Okay.
since we know it's functioning. And then I will, about a minute before the presentation, I'll just lead with a quick introduction,
Okay.
and then we'll be ready for an on-time start.
Excellent.
Now, the attendees do have the opportunity to type in questions as we go. So if you do have time, I can relay those verbally. I know 30 minutes is sometimes a kind of a tight window to get through a lot of material. So if not, not a problem. But that functionality is out there as well.
Fantastic. And then my last name, Mark, it's
Yes,
pronounced Sar, S-A-R, and then Han, H-A-N.
perfect.
Once you know how to say it, if you want to take a stab at almost like there's a hyphen between the R and the H.
Right, Sarhan.
That's it. Really easy. Sar and then Han. But if you don't know how to say that, it's butchered.
Right, I'm sure you get a lot of Hans.
I get Saran, I get Saran wrap, I get all kinds
Uh-huh.
of crazy stuff. But Sar and then Han, if that's the only request I have, otherwise we're golden.
Sure, sounds
Okay,
great.
I appreciate it.
Sure thing.
And then Mark,
Yes,
you want me to throw a jacket on or no?
it's really a personal preference. We kind of whatever you're going to be comfortable in.
Okay. I'm fine
So
like this, but if you want me to put a jacket, that's fine too. Whatever.
perfect. No, if you're comfortable, perfect with me.
Sweet.
All right, so we're about a minute out. I'll just lead with a quick intro here, and we'll be all set.
Okay, great.
All right, everyone, welcome back. Money Show is pleased to welcome Adam Sarhan. He authors the popular FindLeadingStocks.com report, where he helps people buy monster stocks early. He provides actionable ideas that anyone can use in any market environment. He coined the term psychological analysis for investing, which is a third school of thought he uses in addition to fundamental and technical analysis. He holds a BA and an MA in political science, is a contributor to Forbes, and has been quoted in CNBC, Reuters, Bloomberg, Fox Business, Barron's, CBS News, Yahoo Finance, the Wall Street Journal, MarketWatch, among others. Adam, such a pleasure to have you here today. It's all yours.
Thank you so much. So welcome everybody to today's presentation. My name is Adam Sarhan. I'm going to show you how I learned the hard way, by the way, and hopefully save you all of the market tuition that I've paid over the years, both in time and actual hard dollars that I've lost learning this stuff, how to buy big monster stocks early. I mean, that's the goal of what I'm looking to do, right? There's two schools of thought, just right off the top. There's the value investors and there's growth investors, or, leading stocks and lagging stocks, however you want to word it. So it blows my mind because I speak to investors, both institutional and individual investors all over the world. And I always ask, and I'll ask you right now, can you name the top 5 strongest stocks in the market right now? 9 out of 10 people can't do it. And I don't just mean the glamour names du jour, like the FANG stocks or the hot EV stocks or the Cathy Wood ARK funds or whatever the hot stocks are of the day. I just mean on a percent basis, net, like in other words, where it closed on December 31st of last year to where it is today on a percent change. What are the leading stocks in the market? 9 out of 10 people, if not 10 out of 10 people, if not 11 out of 10 people, depending on where I'm sitting, can't do that. So if you don't know what the strongest stocks are in the market, how do you, you're playing a game of based on information, right? So I'm short. If I'm going to play basketball against Shaquille O'Neal or Michael Jordan, I don't have a chance to know what to win. But in this business, it's based on what? Not only can I compete, but I can win. It's based on my intellect, and it's based on your intellect. So if you're a sports fan, every sports fan knows how their team ranks. The Knicks are hot. The Dodgers are poor. The Dolphins, the Jets, the whatever, the Cowboys, doesn't make a difference. In the season, your leaderboard. When it comes to the stock market, where your money, ladies and gentlemen, is on the line all day, every day, people can't tell me the strongest stocks in the market or the leading stocks. And that's where I built the entire core of what I do is built on finding and owning leading stocks early. You don't want to be with the crowd and just buy breakouts. In fact, I'm going to tell you right off the bat from the top, before I even dive into the presentation, not to buy breakouts. That's what everyone else is doing. And most breakouts fail. So I did that for years, hoping that I get different results. And they kept on failing, stopping me out, and so on and so forth. I lost money. So this is a different approach. And I'll get into it. Before I jump into it, lawyers like to get this out of the way. The disclaimers, everything is for educational and informational purposes only. I don't know you, so I can't give you specific investment advice. Everything is general in nature. No recommendations are given at all. This is just general information anybody can use to trade the markets. That being said, I like to say there's an infinite number of ways to make money in the market. Your job, ladies and gentlemen, is to find one that works for you. Just find one. Doesn't matter if you're a value investor, a short-term trader, a long-term trader, long-term investor, position trade, it doesn't make a difference. I'm agnostic to the methodology. As long as you respect risk and you understand that there's risk and there's reward, there's probabilities, like Howard Marks says, and there's what? There's outcomes. You understand risk, reward, probability, outcome, you're going to do extremely well over time. Now, just a brief background about me. My name is A.M.P.D. Sarhan. I founded my investment firm in my dorm room in grad school way back when. I've been trading since the 90s. I've made every possible mistake under the sun, learned from it all, grew up in the fundamental analysis world and then technical analysis. And I realized there's something missing. So I have a book coming out, going to be published with Wiley next year, called Psychological Analysis. And I've coined this third term, school of thought, or this third term for investing and trading, any capital market, by the way. And really the idea is twofold with psychological analysis. One is to outsmart yourself. I call it intellectual arbitrage. And then two, in other words, become a better version of yourself, a smarter version today than you were 10 years ago or yesterday or 5 years ago. That's what I mean by outsmart your former self. And then two, outsmart your competition, which is the market. If you can do those two things, then you're going to be way ahead of the pack. And there's a whole book on psychological analysis that's super, super simplified, but suffice it to say that's that. So my name's Adam. People would ask me early on in my career, why should I invest with you, Adam? I don't know you from Adam, pardon the pun, but I would get that all the time. Well, the answer is very simple. I didn't go to Harvard or Yale or work at the big investment banks. I'm self-made, like I said. So my answer was get in the media, and I've been on all over the major every single major investment media outlet in the world, or at least in the U.S. That is. I don't want to say every single one in the world, but every single one in the U.S. syndicated all over the world. So it's been everywhere. People all over the globe send me stuff that I've been quoted on. And about 7-8 years ago, I can't remember, after the 2009 crash, Forbes reached out to me a few years later and said, hey, would you like to become a contributor? I said, sure. So now I'm a contributor to Forbes with millions of readers there since I've started. And again, my basis is I use fundamental analysis. I use technical analysis. They're both great. I think that there's good here. There's good here. There's bad in both too, but take the good out of both of them. And then add the third layer, which is a psychological analysis. And that's what I do every single week with fine leading stocks. So that's more or less the deal. I've been in the money management business I've gotten all the series 3, 7, 24, 65, and 63 licenses you possibly can imagine. I've held those in the past, don't have them anymore. Completed the Bill O'Neill. I'm a big fan of Investors Business Daily and the Can program. I met Bill, met his son. I've done that whole world. Started off, actually, my first job was at canslim.net, which doesn't exist anymore. But that's my background. So I advise to big institutional investors, have the membership website at Find Leading Stocks, where I share my thoughts on the market. And I do it, it's all based on my AMPed investment system, which is really simple. Anybody can use it. A is advanced, AKA early entry points, which is today's topic. And then M is align yourself with the market. Don't fight it. I know so many smart people, and I put smart in air quotes here, that fought the market and lost. Just about everybody I know that's fought the market has lost, except for literally one person. And what I mean by fighting is he refuses to go long. He's only short. So you could make a strong argument he's lost by missing out on big gains, but he's done very well for himself just being short the market, and that's what works for him. But literally every single other person I know, institution, individual investor that fights the market loses. So what I've learned, it's much easier to swim with the tide than against it. The market is bigger than any individual person out there or individual entity. The Fed is the proverbial elephant in the room, which I have a saying, don't fight the Fed. That's Marty's way saying. My thing is follow the Fed. So P is psychological, and again, follow the market, right? Don't fight the market. Align yourself. Be in harmony with the market. P stands for psychological analysis, which I briefly touched on earlier, and I'll touch on that again. So arbitrage is the concept of there's two different things, and you can make money with the difference in two. Usually it's between two stock prices, gold stocks versus gold, the commodity, crude stocks between crude or intra-sector stocks, whatever the case may be. There's a zillion ways to arb things, right? Derivatives against individual or against that in stocks or whatever the case may be. So the way that I urge people to use the ARB. There's two forms of it for the purpose of today's presentation. I'll briefly touch on them. Intellectual arbitrage is to outsmart your former self and outsmart the market. And then there's time arbitrage, which is understand the profits, ladies and gentlemen, are a function of time. It doesn't matter if you're a short-term trader or if you're a long-term investor. There's an element of time that's needed for a trade to become profitable. Most people are very short-term in nature. They stare at the market all day long, intraday trading. It's not my approach, by the way. My job is to do the opposite. Pattern interrupt, right? Interrupt that pattern. I want to capture the bulk of the move. I want to step up to 30,000 view foot, look at the entire forest, and not get stuck looking at the trees. What I mean by that is, if you look at the forest, that's monthly charts, quarterly charts, annual charts, even weekly charts do a great job at that. The trees are the daily charts, and then the leaves on the trees are the intraday charts. Almost everybody I talk to stares at the market all day, just constantly hits refresh on their phone, refresh, and they just want to get the bing, almost like a slot machine. Bing, the dopamine hits every time they get their update on how their performance is in their portfolio, how it's performing. You know, if you have some kind of itis, bronchitis, or any kind of itis, it's usually a bad thing. Well, my thing is, it's called tickositis. If you stare at every tick in the market, meaning every time the market goes up or down, you've got what I call tickositis. It's not an official thing, by the way. I made that up, but it causes you to make emotional, not rational decisions with your money. And that is deadly, meaning 9 out of 10 people, when you're making really bad emotional decisions, it just leads to subpar performance. And you don't have to take my word for it. Just look at the best investors in the world. They're disciplined. Look at the best athletes in the world. Disciplined. You can read Tim Grover's book. I'm not affiliated with him. Relentless, or his new book, Winning. He was a coach for Michael Jordan, for Kobe Bryant, Dwayne Wade, and countless other massively successful athletes. And he talks about it. Remove your emotions from the process. Period. Let your mind control it. I do the same thing. And Dalio talks about this, and so on and so forth, right? That's the gist of psychological analysis. There's a whole book, there's a whole nother presentation, but I just want to touch on it. So just know thyself. Let me summarize it with that. Next point. D is defense first. Ladies and gentlemen, if you know anybody who's blown up in the market, if you've blown up in the market, I blew up in the market when I first got started multiple times. Again, made every mistake you could possibly make under the sun. But like the song says, I'm still standing, right? I'm still standing. Yeah. That's the beauty here, is that if you've blown up Or think about in 2008, the entire investment banking business model was destroyed. It crumbled. The five biggest investment banks: Goldman Sachs, Morgan Stanley, Bear Stearns, Lehman Brothers, and Merrill Lynch. Three of the five gone. Merrill Lynch bought by Bank of America, Lehman and Bear gone. Right? Bear was acquired by JP Morgan, and Lehman, we know what happens there. Goldman and Morgan, the two people that were standing, or the two entities that were standing rather, they had to switch to commercial banks. They were no longer investment banks. That means the top five investment banks gone. Boom. Just like that. Why? Yeah, they exotic mortgages, more M.P.D, mortgage-backed security. You get into the details. You can watch the movie or read the book, The Big Short. Fantastic, by the way. Again, no affiliation there. Just a fan. The reason why they failed, ladies and gentlemen, is they did not respect risk. Just that simple. Anyone you know who's failed in this business did not respect risk. So I've got a whole presentation there. Again, if you're interested, you can go to findleadingstocks.com or email info@findleadingstocks. Happy to get into it with you. But today's presentation is going to focus on helping you use, or focus on the A in A.M.P.D, which is helping you use my early and what I call advanced entry and exit signals. So you want to buy before the crowd. So the idea here, ladies and gentlemen, is to increase your returns by lowering your risk. Novel, I know. It's almost like my buddy says, remember the movie Back to the Future? McFly, anybody home? Biff would knock on McFly's head. It's the same concept. As traders and investors, the most successful ones in the world, and believe me, I've studied them. I have a podcast called Smart Money Circle. If you go to smartmoneycircle.com, you can see my guests. In order to come on the show, you have to have 100 million or more in AUM, and assets under management. I interview the biggest guys in the world and gals that manage money. Leo Melamed, the guy who literally invented S&P futures and treasury futures and currency futures. Former chairman of the CME, the Chicago Mercantile Exchange, on the show. Interviewed him twice, was invited to his office in Chicago. Jim O'Shaughnessy, countless other money managers. List goes on and on and on and on. Success leaves clues, like Tony Robbins talks about, right? It's not a mistake. They look for asymmetric returns. The smart money. Think of money is divided into two camps. You've got the top 1%, the top 5%, the smart money, and then everybody else, which we'll call the dumb money for lack of a better word. Almost like a Venn diagram, but instead of it being with two circles that overlap, it's a very, very the two separate circles. They're not overlapping because smart money's here, and this is a really small circle, and then the everybody else falls into the other camp, which is the crowd or the dumb money or any other word you want to use to explain it. Not smart money for keeping it worded nicely. You want to increase your returns and mitigate your risk. It's that simple. Nobody knows what's going to happen in the market next week or next year or tomorrow. And you don't have to be wildly successful in this business. It's just that simple. There's probabilities, something's going to happen, and then there's the results. There's an outcome. It's either favorable or it's not favorable. If you respect risk, you'll do phenomenally well. So, what is an advanced entry point? It's any entry point where you buy. I'm just going to use stocks for simple terms and to keep it easy and digestible, but it works for currencies and commodities and any other publicly traded asset in the world, where you can get in early and you lower your risk from where you enter to where you exit. That's all that matters. And look, people say, what's your win rate? I want to have a 90% win. I see guys marketing online. They go 90% win rate or 100% win. Nonsense. The best guys in the world, Stanley Druckenmiller, Paul Tudor Jones, Bill O'Neill, all these guys, they win 30, 40% of the time. That's fantastic. Imagine you have 10 trades in a row. 9 of them you lose, and you lose 1 on every trade. Right? So you lost 9 trades in a row. The 10th trade, you win 100. Net, you're up 91 for those 10 trades. Even though you only won once. The win rate, percentage of wins, literally doesn't matter. What matters is how much you win when you're right versus how much you lose when you're wrong. That's it. You do that over and over and over again, you're going to take losses. In fact, most of the trades aren't going to work. It's a law of nature. Most things in life don't work. Look at an apple tree or any tree for that matter. Most seeds just die. How many out of an apple tree, thousands of seeds come out of it, only 1 or 2 or a handful come into a new and spawn a new tree. It's not my rules. I just play by them. Think about relationships. How many people you go through before you met your spouse or your significant other? Most don't work. Most trades don't work. It's okay. That's the beauty. So again, learning to think like the smart money does. There's two types of exits. You exit for a gain after you enter a position, or you exit for a loss. The key here is to think like a smart institution. Most people are individual investors, and they look at institutional investors as if they know something. The ones that have been around, like Stanley Druckenmiller, Paul Tudor Jones, and Fidelities of the world, they understand the rules of the game, ladies and gentlemen. It's not luck that they're here for so many decades winning, right? They buy early, they defend support, they build the base, they understand how markets work, and they anticipate other people, the dumb money's behavior. And they always, ladies and gentlemen, always respect risk. And if they don't, they blow up. It's just that simple. Or they take huge losses, which are avoidable if you respect risk. So before I jump into the details, there's three states, what I call, in the market. There's up, down, or sideways. After you buy a stock, there's only three things that can happen. I don't care what stock it is, how big it is, how small it is, if it's a whatever. It's not even just stock. Same thing with any capital market for that matter. But it can go up, it can go down, or it can go sideways. That's it. Stan Weinstein wrote a great book, How to Profit in Bull and Bear Markets. Again, not affiliated, but a great recommendation. He came up with stage analysis. He says, hey, stage one, stock spacing. Stage two, there's an uptrend. Stage three, it tops out. And stage four, it declines. Period. Now, you can go into more details, but the idea is to be buying things early. Within the stage two uptrend and within the downtrend here, there's multiple bases. But let's suffice it to say there's stage one. You get in here right there when it transforms or it evolves into stage two, and then you want to be buying and owning it for most of stage two. You can still own three, but eventually every great stock tops out. It's just the nature of the business. It could reset, have a vicious stage four, like Netflix did, or Green Mountain Coffee did, or Apple's done, or Tesla's done, or any of these great guys where they go into their own private bear markets for years. Sometimes they become what I call forgotten leaders, and then they emerge in stage one base again and break out and hit new highs. Define your time frame. Are you that's for stage analysis? So next point, understand, ladies and gentlemen, before we jump into specific signals, there's different signals based on your time frame. Are you a short-term trader? Are you a long-term investor? Are you somewhere in between, intermediate term? Understand what works for you. I'm very good at the big picture. I'm lousy at details. It's just the way my brain works. I wish I would have known that 30 years ago. Ask me which direction to go. No question, I'll nail it. Great on boards. Great as this high-level thinking, strategic advice, no question. Great on monthly charts, weekly charts, annual charts. Big picture, here's the trend, up, down, or sideways. Now, you ask me to go look at a minute chart and trade that minute chart, I'm awful, lousy, period. I stick with what's working. I don't try to get out of my lane. You know, in Forbes, I'm allowed to write about investing aloud. That's my lane. Anything to do with investing, kosher, no problem. I got a green light. So, can I write about politics or the weather or sports? No, it's not my lane. Know your lane, ladies and gentlemen, and stay in it. Warren Buffett talks about the circle of competence. Find out what you're good at, the circle of competence, what area where you excel, and then find out what's important in that area and ignore everything else. And you'll clean up. That's how he did it. He literally tells you how he did it. So when you look at technicals, you know, fundamentals are great for what to buy. Technicals are great for when to buy. That's simple. There's a few things I look at. There's support and resistance, which I'll cover today. Chart patterns, trend line breaks, breakouts, classic breakouts, anticipating breakouts, moving averages, and pullbacks off the high. So I don't have time to talk about all these today, but I'm going to briefly touch on some of them. Support and resistance. Just as in case you're not familiar, support is like a floor in the room. Look at the floor you're in right now. Every time the stock gets down to this area, in this case, it's just above 51, it bounces. Every one of those arrows, it's the big institutions stepping in and defending support. Resistance is the exact opposite. It's a ceiling in the room. Every time the stock gets, in this case, it's below 51, different example, 50-50, they sell and it falls. Happens in any price point. Could be a stock trading between 10 and 15 or 17 and 20, whatever the numbers are. That's the concept of support and resistance. Think of it as an art, not a science. It's not exactly to the penny. It's the spirit of the law instead of the letter of the law, right? The spirit of support, spirit of resistance. So there's 5 ways to think like an institution. I mentioned that you want to buy early, you can defend support, or you can buy early. So think about when you buy here off of support in one of these arrows. Why? Because if you're wrong, you exit right below support. Very low risk. If you're right, look what happens. Merry Christmas. You risk one, you risk this much, and if you're right, you win that much. Take the trade every time. as long as it's within the guidelines and there's an uptrend and so on and so forth. Or if you want to short resistance, the same concept. Because if you're wrong, you get out right above resistance. If you're long, you get out right below support. You risk small. Again, everyone thinks about the reward side of the equation. They don't look at the risk side of it. Think in probabilities. Anything is possible, but not anything is probable. And always, 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 always respect risk. So real life examples. Here's Amazon.com. Full disclosure, it's a position in the 5 leading stocks portfolio. We are up. Let me take a look here. Last I checked was about 70% in the stock. It was bought last year after COVID. We've held it. This is a big base. Now, if it breaks below support, it'll be a stage 3 top. If it breaks out above resistance, it'll be another breakout in a base within a longer term uptrend, just like what happened in this little area. This is just a longer base because it's got to digest, right? So every one of these circles, these green circles, are the institutions showing up and they're defending by, i.e., they're buying support. I'm holding it until support breaks. That's simple. Now, people that don't own it want to wait for a breakout. Classic, technical analysis 101, every chart book, just about every chart book in the world tells you buy a breakout. My experience, most breakouts fail. There's nothing wrong with buying breakouts. You can clean up buying breakouts. Again, for each their own. Find your path that works. For me, I like to buy early. In other words, on the either down here on support or off of a downward trend line or a moving average. Why? Because you've got a little area of support here at 3127 area. If I get in here and I get out there, I'm risking a little bit. And if it does break out, everyone else is buying up here. There's my edge, that yellow area. So think about the casinos in Vegas. Up and down the strip, you've got billion-dollar machines that are machines, pardon the pun, billion-dollar casinos that are make their money in real time. They do it by placing millions of trades or millions of bets in that case, and they have a slight edge, right? 51 to the house, 49 to the gambler, and they clean up, or even more, depending on the game. This is my edge, ladies and gentlemen, and that's the crux of buying early. I know we're running low on time here, so again, if you want more, you can visit findleadingstocks.com. Happy to engage and talk more. So if most people are buying the breakout up here, the problem with that is most breakouts fail, number one. Number two, is where are you going to exit? Below this line? That's fine, but it's still above the 50. It's still above, if it rolls over and just backpedals, let's say it breaks out here, rolls over into here, and then blasts off, you're stopped out for a loss, most likely. Whereas if you bought early, you're not. And then it takes off, add insult to injury, it takes off without you. How many times did it happen to you? Countless times. So institutions step up and they defend support and resistance, like we talked about. Classic entry points, what most people teach you buy breakouts when it breaks above resistance, or you go short a breakdown when it breaks below support. Problem is that doesn't work, and it's not good risk reward parameters from my standpoint. What I like to do is, again, think like an institution and defend support and or buy early. So here's Amazon again. Let me show you because I know we're running out of time here. This is Microsoft. Again, another open position. We're up about 40% there. Again, long-term holding. We've owned this for more than a year, and it's setting up again nicely. And it's set up many times before that I didn't annotate, but real nicely here. And it never triggered the stop, right? Stop is below support. So that's the edge, the yellow area. And this works time and time and time again. You want to trade on what you see happening, ladies and gentlemen, not on what you think will happen. Remember, most breakouts fail. There's nothing wrong with buying breakouts. I know people that do extremely well buying breakouts, but I want to buy a little bit early because it gives me the ability to stay in the stock most of the time if the stock's going to work and it's a big uptrend without having to worry about a normal pullback stopping me out. Now look at this. If it stops me out here, breaks, let's say I buy it, when it breaks above the dotted green line, the downward sloping line, and I get out right below this area here, it broke the 50 and it broke support, this near-term support. I'm out. It could always set up again. I can get back in, but I risk this much. If I buy the breakout up here and it rolls over and goes all the way back down to 250, doesn't break the 50, just tests it and then bounces, probably tagged because that'll be more than 7 or 8%, or depends on the situation, below or 10% below your entry points. Like how much you can let it go for a normal pullback before you get nailed. So the early entry points give you much better risk reward setups. It's just that simple. And again, it's all based on probabilities. So strategies for buying breakouts. You want to buy the breakout with close protective stops, respect risk, always get familiar with the company and how the stock behaves. Every stock behaves differently, ladies and gentlemen. There's lots of different chart patterns you familiarize yourself with. I don't have time today. I believe, Mark, we're going to go to Q&A soon. So if you have questions, you can ask them in the chat, and then we'll wrap up for today. Take a look here at Microsoft again. There's that. And then here's Tesla. Again, another Tesla was an entry point. Here was a head and shoulders bottom kind of pattern. We bought it there early. I didn't shade this yellow, but that was our edge. Everybody else who bought the breakout bought it up here at 205. We were buying it right down here. In 36 weeks, the stock, not the options, the stock was up 500%. To be exact, it was 499 and change. I'm rounding up for simplicity. 500% from here, that early entry point, that break of that downward trend line, it gapped above it. We paid up for it, but that's okay. And we got in months, if not weeks and weeks and weeks before everybody else. It was months before the classic breakout. And it set up again here, tested support. Every one of these green circles, by the way, was big institutions stepping in. And it's setting up against nicely, again, setting up again nicely here. You could have sold it when it broke the 50. You could have sold it and then bought it back again. Again, you could have traded around it. I'm just saying, again, my strength, looking at the forest and not getting caught up with the trees. We did sell this, locked in a very nice triple-digit gain in the stock, and it's setting up again. You can use this downward trend line. You can use that one, or you could have just bought a support, bought right there and get out if that's broken. And ladies and gentlemen, I believe that's all the time we have for today. I do want to thank you very much. If you do have questions, again, ask yourself who you are and where you are and what you can do, but you can visit Find Leading Stocks. I'm happy to help anybody going forward.
All right, Adam, thank you so much. One of our attendees, they wrote in, they're wondering what percentage of breakouts fail?
It depends on the environment and the market. So that's a very good question. If it's March of 2020, March 23rd of 2020, I remember that day perfectly. That's when the market bottomed, and I had an intraday note sent that, or intra-week note sent that day, giving the green light to buy because the Fed was stepping in. Anything you would have bought from March 23rd, let's say for the next 3 months, 4 months, I don't want to say all 100%, but the rate, the percentage of wins of breakouts that worked in that environment, even for the next 3 to 6 months, was extremely high. Why? Because you're coming out of a bear market. Early stages of new bull markets or uptrends, whatever, however you want to define them, semantics aside, are extremely ripe for any strategy, or just about any long strategy, right? Now, in the last 3 months or 4 months in February up until March or April of 2021, after that huge move in the NASDAQ and the S&P and the Dow, the market's been choppy, specifically for growth stocks. So the most breakouts have failed. It's just the way the world has worked. So it depends on the market. The M in my A.M.P.D investment system is the market. Know thy market, know thyself. So the percentages of breakouts varies depending on the conditions in the market. Think about this. If you go outside in the middle of a hurricane, you can get blown away and or get wet. Let's just keep it simple. If it's sunny outside, you're not going to get wet, right? So it depends on the market. Is it big waves crashing on the side, or is it raining hard outside, or is it not raining at all? Is it drizzling? That's kind of the context of the percentages.
All right, perfect. We had another viewer here. They're wondering, what's the cost of your service, and is there any way to acquire the slides?
Sure. The cost of the service is very inexpensive. It's $99 a month. You can sign up for the year and get a discount for the normal membership. We have an aggressive portfolio, which is a little bit more than that, but you can go to findleadingstocks.com and you can sign up there. And if you do that, it comes out to a cup of coffee a day. It's $20, $25 a week. If you're not willing to invest that in yourself, and again, this is education, it's to improve yourself, then it's not for you. It's just that simple. But you can go to findleadingstocks.com and sign up right away. Let's see, it's right here. So you can get it right there, and it's put your name, email, and you can start a free trial. So it's free for anyone who wants to try it.
Excellent. Thank you so much. Another viewer, they're wondering, what sectors are you looking at now, and how do you decide how to shift?
Oh, that's a great question. So I'm very bullish on gold and silver. I think the GDX is setting up really, really well. Let me show you this chart here, for example. Yep, gold miners right there. It's already pulled up. Look at that tight consolidation. Oops, it just shifted. 1 second. So because I'm always looking at leadership, ladies and gentlemen, I'm not getting married to any one idea. If a group, like look at First Solar, for example, after March of 2020, after COVID hit, you had the stay-at-home stocks did extremely well. Zoom, think of Tesla, think of, which is funny, it's a stay-at-home stock, but it's also a solar stock, right? The solar stocks did exceptionally well. Now the solar stocks are literally the worst industry group in the market. So when things change, you've got to be ready to change as well. And now what's taken its place, funny enough, the oils, right? You can look at the OIH or the XLE commodities. You've had a big inflation play, have taken off. But for me, I'm a big fan of gold and silver right now. I think that this consolidation, the GDX, which are gold miners, is extremely bullish. I'm agnostic when it comes to making money. I don't care. I'm not married to any one specific idea or one area or rule of thumb. Sometimes growth is leading. Sometimes value stocks lead. I just want to make money, plain and simple. So, and of course, respect risk, right? People look at the reward side of the equation. If somebody comes to me with this, the calculator, and if I just buy X amount, I'm going to buy a Ferrari and you get lost in the weeds. So look at the risk, because that's what most people aren't doing. Again, interrupt the pattern and think differently. That's what the smart money does. So I'm a big fan of GDX. I like the semiconductors a lot. By the way, we talked about holding support and the big institutions defending support. Look what happened here last week in the Qs. I'm a big fan of the Qs, by the way. And the service is along the Qs with a gain of about 85%. So full disclosure, 316 was the low here. And this is in real time, by the way, right there. The next day, the low was 316.90. And I can't make this up. Last week, this big reversal was 316.30. So if that's not the big institutions defending that 316 area, and then that last few days, by the way, this is real time for you guys. So you don't think like, oh, Adam, this happened in the 90s or the 70s or whatever. It's happening right now. It's evergreen. It's never going to change. You walk into a crowded theater, yell fire. You're going to get the same reaction anytime in history, 5,000 years ago or 5,000 years in the future or right now, right? It doesn't matter their wealth, their education, their socioeconomic background, their race, their religion. People are going to scram for the exits. Same thing in the market. And that's why these things work over and over and over again. That's the basis of psychological analysis. And I'm a big fan of these guys. If this can break out above 343, the Qs or the growth is going to come back to life. And then, of course, the airlines are doing very well now. Also, we made good money in retail stocks. Macy's was a good one recently that popped. Let's see if this thing loads. And again, boring stocks sometimes are in favor and they do exceptionally well, right? Here's Macy's. And you look at that move from $7 to 22. I typically go after institutional quality stocks. I don't do any penny stocks, by the way. That's not my thing. I go after large institutional quality stocks, liquid stocks. I need liquidity. And Nordstrom did very well there also. That was a huge move from there to there. So I'm agnostic to the area. I always look for leadership. And I share it with my members every week. There's a 1 weekly report. And if there's an intra-week update based on actionable ideas, buy here, sell here. So simple. Anybody can follow it.
All right, Adam. And just to close this out, one attendee, they're wondering, how do they determine the percentage of risk they should be willing to risk per trade?
That's for each their own, right? Some people I know are very comfortable risking. Well, there's two sides of risk. That's a very important question. Risking 2 to 5% or 7% below your entry, 8% below your entry. Some people are 10% below their entry. It depends on your position size, right? How big of a position are you taking? So one side of it is from your entry point to your exit point, what's your risk? That's one side. Typically under single digits, under 10% is more or less acceptable in the actively trading world. If you're a longer term investor, that number varies. But for active speculators, right, that's on single digits, 7 or 8% tends to be the range. Now, you can scale out. If it goes down 2%, 5%, 7%, then you're out 100%. You don't have to beat all or nothing, right? That's one side of it. The other side of the risk, which is so important, ladies and gentlemen, please keep this in mind, is what happens to your portfolio if you're wrong? How much of your portfolio are you going to risk on any given idea? So let's say you love XYZ and it falls 7%. Then what? That's what happens to your portfolio if you're stopped out. That part of the equation is huge. The big institutions don't, to my knowledge, don't risk more than 1% of their portfolio on any one idea. So that means if you're stopped out for a full loss, doesn't matter how wide that stop is, you can adjust the position size. So the impact on your portfolio is less, 1% or less, depending on how aggressive you are. That tends to be a good area. 20 basis points, 50 basis points, 75 basis points, 100, 1%, 100 basis points, 1% of your portfolio. So if you have $100,000, you're going to risk $1,000 on any given idea from if you're stopped out from entry to exit. So there's two sides of that answer. One is your entry to your exit. But two, more importantly, what happens to your portfolio if you get tagged? And most trades are going to lose. Go into it not with that knowledge, and you'll do extremely well over the long term.
All right, everyone. Well, we are speaking here. Adam Sarhan, founder and CEO of 50 Park Investments. Be sure to check him out at findleadingstocks.com as well. Adam, thank you so much for being here, taking the time out. Greatly appreciated.
My pleasure. See you again soon.
Bye.
Thank you for having me. Bye.
All right, everyone, a big thank you for all of those in attendance. Be sure to reach out to any friends, family members, colleagues that you have. Tell them about our virtual platform here. Have them register and find more fantastic presentations like the ones that you just watched. Stick around. We have more great content coming over the next 2.5 days. Thank you for being here.